we saw the housing market peak in 2022, from sales, from, the pricing data. I think median home price can be very misleading during these turnings or inflection points, but that was the peak. And we have been turning in housing since then, and it moves at such a glacial speed. And so we have just, in my opinion, of that turning, reached the inflection point where it's happening all over the country, not just in Florida, in Texas. People are waking up and becoming motivated sellers.
Welcome to Thoughtful Money. I'm its founder and your host, Adam Taggart. Yesterday, I had a private conversation with housing analyst Melody Wright. In it, she revealed how shocked she is by the latest stats that show how quickly the housing market is starting to unravel. Record low transactions during what's normally the busiest time of year for home sales. Inventory up nearly 30% year over year nationally. And of even greater concern, spiking delinquencies, in some cases at rates worse than seen during the 2008 global financial crisis. In Melody's words, this is the turning point and winter is coming for the housing market. Not that you'd know it by looking at the median existing home price, though, which just hit another all-time high. So is the country really sleepwalking into another housing crisis? Well, we'll find out now as Melody kindly accepted my request for her to join me today for an impromptu discussion on this very important topic. Melody, thanks so much for joining us today.
Thank you for having me, Adam. It's my pleasure.
Oh gosh, it's always such a pleasure, Melody. Just to give folks a little inside baseball, we will pick up the phone from time to time and call each other and have some nice long discussions about what we see going on. Thought I'd do that with you yesterday and really, heard in your voice your level of concern and to a certain extent, shock and surprise at how quickly things are starting to unfold now. So we had a great conversation and I sort of said halfway through, hey, Melody, we really need to share this with the greater public at large. Do you mind coming on tomorrow, even though we weren't planning on it? And you very kindly agreed to do so. So thanks for making the time.
You are most welcome. Thank you.
All right. Well, look, I don't really have my normal arc of questions all thought out here. One, because this is impromptu, and two, because I think so much of what we're going to talk about is contained in the two recent pieces that you released this week on Substack. So maybe we should just start there. I mentioned some of the high level stats in my intro here about sort of, the general situation where we seem to have a lot of these like deteriorating fundamentals, and yet, like a duck furiously paddling underwater, things still look very calm on the surface here. So what are you looking at most closely right now, and what has you most worried?
Yeah, so Adam, just before I got on, I got to see what Black Knight said about these delinquency stats I'm going to talk about. So I'm a little fired up. But
Okay.
it started a couple of weeks ago when I pulled delinquency for June. And so I can see early, so I have client books that I can see, as well as I can go into the back end of the Black Knight system. They're an industry, kind of like what the industry standard for metrics around origination and servicing, because Black Knight is owned by ICE. They actually own both of the big origination and servicing software. And just to remind everybody, servicers, are the people that take your payment. So you might know your originator as the people that closed your loan. Sometimes they can be the servicer too. But typically, a lot of originators sell your loan right away to the agencies, and then another servicer takes it over. And so Black Knight theoretically is supposed to have a whole bunch of these servicers on its platform, and that's how they have these, in their view, 80% of servicing. They can report out what's going on for delinquency, and it's kind of the go-to for people in the industry and outside of the industry. So when I pulled that information, I was shocked. I've been tracking all of these metrics for a very long time. I used to manage default back during the crisis, and we had been tracking along with, defaults increasing, getting stickier and stickier with curing. And this is what you'll see often with default. There's a push and pull kind of where people will default, then they'll cure, then they just, maybe a family or a family member or friend helps them out. And so we were seeing it, but we were seeing later stage delinquency get sticky. And then when I saw these results, we saw over 19% increase in month over month in 30 plus delinquencies. Now, I want to explain, I think you and I talked about this a little bit, but in this country, we're all obsessed with our credit score. We know that if anything happens to that credit score, then credit is going to be more expensive. I'm not going to get as good of a rate on my car loan. I'm not going to get a good rate on my credit card. And so we guard those. I mean, there's a whole industry out there that will tell you if you have the slightest little change in your credit score, right? And so you don't make that decision lightly to go 30 days late on your mortgage. It is a decision of, oh dear God, I really don't have any other option now. I'm going to have to hit that 30. And there are habitual late payers. I used to track this actually because guys, this is how banks think. I'm just going to tell you right now. They love it when you're late. They love it. They love it if you're 15 days late, right? Because they can charge you that late fee. It really is like 6 to 7 days late. But they want to make sure you get current by the end of the month. And so they find their juice a lot of time right there in the middle of the month when people aren't paying. They like that because they can charge that nice late fee, okay? So inside the bank, you're always tracking the percentage of that pull-through rate, what you think that's going to be, because going 15 days delinquent is just fine. Going 31 starts an entire different costly process they don't want you to do. And so I know from watching this stuff for years that habitual late payers often wait till the 26th or 27th day to pay their mortgage. They'll wait all the way up, but they never want to go over that 30-day mark because they know it will get reported to credit. So to do that, to make that decision is not it's not one taken lightly. Now, have things changed since I've been inside of banks and non-banks? A little bit. People are a little more, they're kind of expecting the government to come in and pay our debts. And so I just want to say that out loud. Like, it may not mean as much as it used to mean, but we have not seen an increase like that since 2020, since those huge increases in April and May of 2020 of delinquency. And so to go back to a period during the GFC that this is similar to see an increase like this in 30 plus days delinquency, you'd have to look at August 2007 to September of 2007. And so when I pulled this information, I have to tell you, I was shocked. So 13% all in month over month delinquency. This is not just FHA, which I've been talking a lot about, which has a lower credit profile. All in 13.6 increase month over month in all delinquency, and then a 19% in 30 plus day delinquency. So all of the tiers increased, but what's really concerning is that early stage delinquency. And I'll pause for a second and then kind of tell you how Black Knight messaged it. But I want to see, I've just said a lot, so I want to make sure, see if you have any questions with what I've said so far.
Well, I just want to try to restate it to make sure that I have the main point I think you're trying to make here, which is that move from somebody to under 30-day delinquency to over 30-day delinquency is a big move, because that's really a psychological capitulation where they say, you know what, I've run out of tricks to be able to, keep things going without fees, without big problems. Now I can't, and I just, now I'm bad. I'm delinquent in a bad way, and obviously that's a precursor to even bigger things like foreclosure, bankruptcy, that type of stuff, right? That's sort of the gateway drug into it. I imagine you're nodding as I'm saying all this.
Yes.
So you said we saw a 19% jump in those 30-day delinquencies on a month over month basis. So we're not talking year over year, we're talking month over month. Given your level of shock, I'm going to assume that's a lot higher than what the baseline was leading up to this. And if you can tell us what the baseline generally was for, just comparative sense, great. But I think the most important thing is what you said is we haven't seen this type of jump in 30-day delinquencies outside of the bursting of the housing bubble back in 2007, and then COVID, where we shut, April of 2020, where we had a global pandemic and we shut the entire global economy down. So extraordinarily extreme situations, where right now we're in, July of 2024, where everything's supposed to be just fine, right?
We're all employed, right?
Well,
I
yeah,
mean,
low unemployment,
yeah,
GDP growth just surprised to the upside, and
yeah,
the stock market is near all-time highs, housing market, median price at all-time highs. So
correct.
everything's supposed to be fine, but we're seeing these crisis level indicators here. Did I capture why you're so concerned about this, right?
Yeah, you did a great job. Thank you.
Okay.
Personally, so to do baseline, I'm going to go back and try to look at, what is the average increase during this time period? I've got the historical data now. I've pulled it. However, I can tell you just from somebody who watches it, I can't remember the last time we had more than a 4 to 5% month over month jump.
Okay.
Like if I'd had something like that, I would have been out on X Twitter screaming about it as well. So double digits is like blowing it out of the water, which I can tell by looking at the way that Black Knight and ICE tried to manage this message, as well as Market Watch. So
Okay. Well, now let's get to that then. So they've had this disastrous print. Now they're going to try to put some lipstick on the pig to try to keep people from freaking out. How are they trying to do that?
yeah, so I knew they would. I kind of mentioned this to you a little. So, month end, it was on a Sunday, okay, this month. And so they immediately, like the headline is actually hysterical. Calendar driven spike in delinquency is the way ICE actually, and I just posted this on X Twitter just before we got on, Adam, because I just, I was curious because usually I get an alert about their release right away. And I was like, have they not come out with anything? Because I really wanted to see before I talk to you. And I go out there, I see it. And so what happens is, let's take those habitual late payers. What they're trying to say is, because the month ended on a Sunday, those payments didn't get to your servicer in time to make the cutoff. Okay, so that is so disingenuous. Servicers are set up to effective date things depending on when they come in. And if Black Knight doesn't know that, then they don't know this industry. I mean, it's insulting. But then I have to remind myself, who's left in the industry that knows default? I don't know. I mean,
Mhm.
there's not a lot of us, and so that's where you wonder, is it ineptitude? Is it on purpose? You just never know. But essentially they're saying that because the month ended on a Sunday, we had this spike in delinquency because the payments came in later. Well, that's not how the servicers work. They'll effective date it. They'll do everything they can to get you before that cutoff date around the 6th or 7th of the month. But how do I know this isn't true? Two different ways. One, I looked back in my client books. I saw spikes in delinquency that were worse than what I was seeing in Black Knight. I went back to see, okay, how many cured after the end of the month? So I'm pulling down reports, right, to see if they cured. A handful of them cured, of course. That's the waffle back and forth that I was telling you about, but not materially. Secondly, I just tweeted out March also ended on a Sunday. Okay.
Okay.
And
But that wasn't a
delinquent,
problem back then, right? Yeah.
delinquency went down.
Yeah.
So, and that's what really kind of what bothers me about Black Knight saying this. I think if I was writing the variance analysis for this, I used to be a financial analyst, I would say absolutely cutoff could have some impact on it, as well as the July 4th holiday. However, it was Good Friday at the end of March as well. I would say that, but I would say still, we've never seen this kind of, or if I'm going to say a qualifying statement like typically a month ends, end on a Sunday, I'm
Hmm.
going to give examples. We don't have to do anything like that anymore, Adam. We don't have to say facts. Facts just don't seem to matter anymore. So will we see this come back a little bit next month? I absolutely believe that, but not because of that it didn't happen. It's the nature of default. all these people are going to get calls on the 36th day of delinquency by their servicer. They have to. The CFPB makes them, Fannie Mae, Freddie Mac, and they're going to say, do you want to go on a repayment plan? Do you want to go on a forbearance if they haven't already used that? There's these unemployment forbearances as well. And so a lot of these are going to get caught really quickly. But the most important thing here is what it says about the consumer. So whether they get caught up, this delinquency, as you know, is not a huge part of my thesis of what's happening in housing, except for the fact that these people won't be buying new houses. They won't be, qualifying for new luxury rentals and things like that.
All right. And, I don't have the chart here with me, but I did see a chart recently focusing on the increase in delinquency rates in a number of different types of loans, mortgage loans being one of them. And the most notable thing I had taken away from that data was it was the greatest contributor to that spike in 30-day plus delinquencies was people who were reporting loss of income. So this goes back to a lot of discussions I've had on this channel about the labor market worsening and in many ways being substantially worse than what the headline data has been telling us. And you're basically sort of saying, hey, same thing about housing, right? Median price still going up on an existing home basis, but there's all this turmoil beneath the surface. So, okay, so like you said, this delinquency part, it's certainly a validating factor to the warning bell that you've been ringing, but by no means is it the only component of it at all. So where do you want to go next? I mentioned in the intro, we've got transactions at about the lowest they've ever been, which is a bad sign, obviously. We certainly have inventory growing in a lot of markets, so much so that the stat that I've seen in the media is that inventory nationally is up over 23.4% year over year. But I believe when we talked yesterday, you said you've got some other data you've looked at that suggests it could be even higher.
Yeah, the Fred data which they get from realtor.com, but that's at 29%, 30% basically. And then there's other information out there that just looks at new listings. I can't get just new listings. I don't have that data, but when looking at just new listings, I've seen a stat for over 35%. So, it's going up all over the country, and out of season for many locations. The Florida season really ends in April. And so for them to be growing inventory at all is really atypical behavior. But we're seeing it all over the country, not just in Florida and Texas.
Okay. Obviously, Florida and Texas right now, pretty much the epicenters of a housing correction, right? Now, the question is going to be, is it going to be a localized correction or is it going to be a national correction? And as I understand it, and please clarify anything I say that's wrong, we're sort of seeing what we would expect, which are the markets that went up the fastest, that were the hottest from a speculative basis, are the ones that are correcting the most right now. And part of that, I think, is due to FOMO and just investor sentiment. People got in there and they just started doing mindless buying because everybody was afraid of getting left behind. But also, too, that's where the developers focused their building projects because that's where people were buying the most, right? And so now you kind of have this dual punch of demand cooling off while additional new supply is starting to come on the market. And then if you start having additional existing supply come onto the market, man, that's just going to make things a lot worse. So look, well, I'll let you take this wherever you want to, but I guess the theme that made me call you yesterday was because I'd seen enough data that suggested, okay, you know what? We have an increasing number of places in the country that are having a supply issue, meaning too much supply is now coming online. We've heard this narrative forever about we've got a national housing shortage, and that's why housing prices are not going to come down. And that's been used to justify why prices didn't come down and maybe shouldn't come down, even though mortgage rates went up so much, which I never bought. But now we're seeing an increasing supply problem in a lot of the market. But I also think that has a twin sister of a decreasing demand issue. And so this is kind of like, the worst of both worlds potentially for the housing market going forward. Am I right to be concerned like this?
Yeah, I think you're right to be concerned, Adam. And I think, we saw the housing market peak in 2022, from sales, from, the pricing data. I think median home price can be very misleading during these turnings or inflection points, but that was the peak. And we have been turning in housing since then, and it moves at such a glacial speed. And so we have just, in my opinion, of that turning, reached the inflection point where it it's happening all over the country, not just in Florida, in Texas. People are waking up and becoming motivated sellers. They just got their escrow notice that told them their insurance and taxes have gone up, and now their payment is 600, 700, double. I've even seen triple escrow notices of what they're going to have to pay, especially if they did like a low balance mortgage. And so they're getting these in the mail, and so this is it's just exacerbating the unaffordability. People are coming to a recognition that they can't afford to hold on to this home. And at the same time, the builders, they bought the inventory myth hook, line, and sinker. And it wasn't just in the Sun Belt states. Sure, the nationals, everybody wants to think they're super smart. We'll see here. I don't think so. But the local regional builders, even in your areas like Pittsburgh, your smaller Northeast locations here where I am, if there was land, they went and built one of these subdivisions, or they really participated in the fix and flip market. That happened here in my town in East Tennessee, very small market, shouldn't have been impacted like what I've seen down in Austin and other places. So I don't think this is isolated to those Sunbelt states. I think that there is enough of the speculation all over the country that the whole country is going to be impacted. Now, there will always be locations that do a little better, but for those of you out in California that want to talk about how you guys have been immune, I can tell you what I'm seeing right now is sure, year over year sales, you were doing a little better than everybody else, but month over month, you're doing a lot worse. And so things are coming to a screeching halt in California, while at the same time, inventory is flooding the market. In my last 19 months of tracking this myself, just looking at these cities, these markets in California are hitting their highest levels of inventory ever in my tracking. Now, is that a 2019 level of inventory? Well, you guys also have probably the largest majority of private note sales because those typically happen in those luxury markets. And so for the argument about, they're not at 2019 levels, I think some other things have happened, which is people are transacting outside of NAR, outside of the MLS and things like that.
All right, so just to note for folks that maybe didn't watch our previous video, Melody, where we talked a bit about the private lending market, I think the point you're trying to make there is, back in the great financial crisis, people are saying, well, that's not going to happen again because we've tightened up lending standards and we're not making super bad loans like we did back then, right? And what you're saying is actually, we don't know this time around because there's so many loans being made now by private lenders that don't have the same scrutiny that the banking system has now, that they could be making those bad loans. We just don't know.
Right. And then the government stepped into the regular market to make those loans with FHA. And so we've got this private lending market we don't know anything about. We do know that FHA is over 10% delinquent, and that's after all of the programs and the 40-year modifications. And that's what I would call government-backed subprime, which has doubled as mortgage outstanding since 2009.
All right. Let me ask this. So the way that you've explained again on previous appearances on this channel, that the government, very much like the way it did with the education market, where basically if you get an education loan, you're getting it from the government these days. They basically pushed out all the private lenders. You're basically saying it's pretty darn similar now in the home mortgage market, where you have these, sure, you may have one of many companies that actually sells you the loan, but then they immediately turn around and they flip it to the Freddie Mae,
Freddie Mac,
Fannie Mae, Freddie Mac, And so basically the government is kind of like the nation's mortgage holder now, right?
They are.
So
Yes.
during the GFC, we had to worry about these too big to fail banks going down because they were holding, this bad debt on their sheets. Now it sounds like it's on the government. So, you know, do we have do we need to have sort of systemic worries this time around? Now I know at the end of the day, if there's massive defaults, the government has to absorb it, and that's sort of at taxpayer expense, and we all collectively, share in whatever comes out of that. But I guess my question is, does it keep us from having to worry about like, oh my God, the banking system's going down because banks are dying?
Uh, I wish, but really what we have to, so what the agencies have done, Fannie, Freddie, et cetera, what the banks have done is a lot of risk transfer, these CRT, credit risk transfer securitizations, where they take pieces of the securitizations and sell them off to pension funds and things like that. And so where is all this leverage? It's hard to say, but everybody's pushed it off away from themselves onto, I think, largely private equity and the pension funds. And I think anybody saying that the banks, even when we talk about commercial real estate, I mean, they're the ones giving out the loans, oftentimes syndicating loans, and so they have this exposure as well. What we don't know is how much of it they have rehypothecated through these credit risk securitizations, which take off pieces and parts of these portfolios even further. It's the rehypothecation we saw in The Big Short, the casino scene, where everybody's kind of betting all behind Selena Gomez.
Okay. I'm going to try to resist to keep going down this path just because we could spend the whole time talking
Yes.
about it. And it's super fascinating, but I want to claw it back to the core of what I want us to talk about here today. So, um, you said something that I just want to make sure is real clear for folks, where you said, look, um, we've been seeing for months and months, probably over a year plus, the stats that show that home prices have gotten to record levels of unaffordability to prospective buyers, right? And so we've seen all the stats of the huge numbers of people that are giving up on ever being able to buy a house, right? And to a certain extent, homeowners have sort of been able to sit in the catbird seat and say, oh, I feel really bad for you guys, but at least I'm really happy sitting here on my 4% mortgage, and I'm going to be okay, right? But this is why inflation is so nefarious. Is, yeah, you can cheer your home price going up if you're a homeowner, but then all of a sudden you realize, oh, wait a minute, but then that means that my insurance goes up and my property taxes go up and the cost of maintenance and repairs go up, right? And so I heard you say, in addition to the aspiring home buyers who are basically priced out at this point, existing home buyers, an increasing percent of existing home buyers are saying, wait a minute, I can't afford the house I currently have,
That's
right?
right.
All right, so we have this massive unaffordability problem, and it now has metastasized from just the aspirants to the existing homeowners. And again, Melody, this is coming at a point where we are not, these are quote unquote good economic times. So it sounds like you're seeing really concerning data that says, hey, people are increasingly being forced to sell here, even if they're sitting on a quote unquote, low mortgage. Um, what happens to all of this if we start having layoffs at scale?
Yeah, it's just going to get worse, Adam. And in many ways, back during the GFC, what really started was the non-traditional products, the investor loans, the subprime, like the FHA, except it was on private books. And then your prime borrowers got into trouble, right? As they were losing jobs, but also as expenses were increasing for similar reasons. Home prices had gone up. And so I said on your show, I think it was September of last year, the very first time we did a show, I said, I don't need to see further job losses. If we just stay on this path and nothing else changes, you're going to get to delinquency, because people simply can't afford the house they have based on these increases in prices. But if we get layoffs, it's going to make it even worse. And that's still true. It's just, I mean, I think that I think this is happening a little bit faster actually than I anticipated, which, you know, we always think this will happen very quickly, but I think, it just, we then realize, no, it takes a really long time. And so to see like changes like this, and especially in 1 month, are a little shocking. We can talk a little bit about the sales now if you want to, because those were just shocking for both existing homes and new home sales.
Let's talk about it. I just want to make one note on what you said. So I'm not taking a victory lap here. It is too early for me to do so. But folks who have been hearing me just pound the drum on the lag effect from these policy changes, these extreme policy changes that we made 2 years ago, this is exactly what I was talking about. So, this is just basically all the disruption that was set in motion 2 years ago, propagating through time. And we're now finally at the point where it's beginning to manifest in the economy. Where it goes from here, nobody can say with absolute certainty. Melody and I think we have a pretty good sense of it, and we'll be tracking it obviously for y'all here as time goes on. But this is exactly what I was talking about when I was talking about why we have to respect the lag effect. All right, so sales.
Yeah, so sales. So, when we read articles, I can't even imagine the consumer who has to get this news and not understand, because they hear about existing home sales and then a week later they hear new home sales. And so you hear sales are down, sales are up. I mean, it must be like schizophrenia for the consumer and hard to keep up with. But when you look at seasonal patterns, the housing market has a very distinct seasonal pattern, which is not like, it does not equal seasonal adjustments, FYI, but it has, because of the school season, because of school starting, ending, when people can move, things like that, when people get their bonuses. You can see that all the time in mortgages. They get caught up, similar to the way they do in the auto industry. So we have real seasons in housing. And if you look at the last 25 years of history, you can see that arc very clearly. I've shared that on X Twitter, kind of those seasonal arcs of price changes for both new and existing homes, as well as sales. And so what I think happens is, in mainstream media, they don't want us to contextualize anything, right? They want us to look at, oh, it's just month over month or year over year, so sales are up, everything must be great. But what if, or actually sales are down? Then you don't realize that last year they were also down exponentially, things like that, or you get a tiny little move up. And so we all swing on this news, but in reality, and that's the combined sales chart. And this is a great chart to kind of look at the seasonal pattern for sales. And I put some key years on here, as well as the 25-year average. And what you can see is that, and this is a combination of both existing and new homes, is that you really peak in that June month in terms of sales. And you can see that black line for 2024 is very clearly veering off track. And
And
so,
it's for those that are watching, or sorry, listening on a podcast and can't see this, of all the data series on this chart, 2024 is performing the worst, and the most recent June data is the lowest June reading from the entire series.
that's correct. Yes. And, for everyone on in social media, that when I ever would even mention 2008, you'd immediately get slapped like, are you a crazy person? But in reality, our housing market is worse than it was in 2008, at least the housing market we know about. Now, I would be hypocritical not to mention that part of the reason these sales could look so low is that we have started selling homes more in those private markets, more in like on social media, things like that.
Mhm.
But I don't think it really matters. I think that buyers and sellers, the sellers are still delusional. They're getting more motivated, but the buyers are not delusional. The buyers cannot afford it. They can't even afford their home they're in. What is it? We just saw that article from CNN. 39% of Americans are afraid they can't pay their bills, 2% higher than the GFC, which was at 37%. And so they're afraid they can't pay the bills they have. who is going to be out buying homes? Okay, then everybody says, well, the rich, and Bloomberg had to have, put out that article yesterday after those abysmal sells that talked about the luxury market, as if to say, hey, everybody, you guys are going to be fine. The reality is every single market I look at has luxury that's been sitting and sitting, some of it for over a year. And so, everybody's just trying to take whatever they can to deny that this is happening. But super prime is also getting hit. Luxury is also sitting and getting hit. And so, I don't care where you are. There's just so many homes one wants to own and pay
Mhm.
ridiculous taxes and ridiculous insurance. And, if you're down in Miami, $150,000 for your housemaid. So, the rich aren't going to take on all that expense for the rest of the country.
Well, if I can just chime in here
Of
to
course.
let you corroborate this. So, my understanding of why existing home prices are still hitting record highs um, is largely because of the high end of the market, right? So the lower end of the market, to your point, they just they can't afford, they can't, yeah, even if they want to, they can't afford to buy anything under these conditions, right? And therefore, tons of transactions that would have otherwise have happened are not happening. So basically, the transactions that are happening are largely dominated by the wealthy, right? And what you're saying is the octane and even the super prime, the wealthy tank is starting to run on fumes here. So don't expect that to continue for much longer. You're nodding as I'm saying this. I'll say one last thing and I'll let you chime in. I just put on Twitter the other day two reports that I had read, two recent reports. One was um, Winnebago, they missed their Q2 sales numbers, stock got hit, which basically, is a good indicator that people are not buying RVs at the rate that they have in the past. And if you look at RV sales over the past couple of years, they spiked in like 2022 because everybody was buying one, during the
Like
pandemic.
houses. Mm-hmm. Yeah.
Yeah. And then Polaris just did the same thing earlier this week, and they make ATVs and jet skis. So basically, the toys, right? The toys of the not necessarily the uber rich, but the toys of the affluent, upper middle class, lower upper class Americans, they're getting to the point where they can't afford the toys anymore, right? Which I think is another indicator. And I've had John Rubino on this program who for years has talked about the RV index, right? And when that starts tanking, that's a good early indicator that the economy is starting to roll over. So, but anyways, I think it corroborates your point there, which is just that the folks at the higher end that have been powering the average home price to new highs in this market, they're beginning to tap out too, along with everybody else.
Absolutely. I mean, and you can see it. And I actually retweeted your tweet because of all the RVs I've seen and spillover lots all over this country. I'm waiting for the RV companies to get a bailout and those become affordable housing. There are just so many of them everywhere,
Yeah.
all over the country. But yes, that's exactly right. And I think watching this slowing down in California month over month, and of course, one month does not a trend make, but what was powering a lot of this was California. And I think they were riding the stock market sentiment wave. And a lot of these areas that, that work for these companies are see their 401k and say, okay, I can afford that $1 million home, which in California, as you know, doesn't buy you a whole bunch. But that is now slowing down. And you're seeing it everywhere. In my neighborhood on the way out to the farm, I've seen an RV go up for sale, two boats, a car, two lawnmowers, all of this in the last 3 weeks. And so I would just encourage everybody, just look around you. Are you seeing similar things? Because it's there.
Well, so if you can, just you told me a little anecdote yesterday. I think it's the same road you were just talking about where you saw the boats and the lawnmowers and stuff. But it's a road that you drive frequently, and you were telling me in just, what you started noticing over just the past couple of months. Mention that it's an anecdote, right? But I think it's an anecdote that probably many viewers may identify with and say, hey, I'm seeing the same thing where I am. And then I want
Yes.
to take that anecdote and ask you a couple of questions around it that
Sure.
hopefully scale nationally.
Yeah, so for the longest time, probably 7 months, there was one house for sale, which is still for sale, by the way. And then probably 6 weeks ago, I saw another house go up for sale. It looked like it was in a bit of a disrepair. If you look in the inside of it, looks like it was a work from home. There was definitely a home office. And then about 2 weeks after that, I saw a foosbo. That's what we call them, but they're for sale by other, which is also a sign that we're in stress when people don't think they can pay the commission to the realtor.
Hmm.
And so all within a span of 6 weeks, you basically went from one house for sale, to three houses for sale, and none of them have moved. No bites, no offers. So I think that is telling as to what's happening across the country right now.
Right. Plus all the toys you said
Correct.
started coming in the
Yes.
same street. So yeah, I mean, just visualization that people are beginning to say, you know what, it's time for me to get out here, whether my hand is being forced or whether I just think the time is right. We're beginning to see that, and I think a lot of people watching will probably have their own anecdotes. And folks, if you do, share them in the comments below. All right, so you were talking about, okay, we've got aspiring buyers who've been priced out, but are now beginning to say, I'm trying to remember the source of this article I just read, but it basically was saying um, that they are awaiting lower rates than just a rate cut, right? So they're now realizing that, okay, mortgage rates might start coming down. Time is on my side. So I'm gonna see how low things go here, right? So they're even if they feel like they may be in a position to buy or buy soon, they're saying, look, I'm gonna be patient because I think I might actually get a better deal here, right? So we have that crowd waiting it out, sitting it out. You now have the existing homeowners that you were talking about that are beginning to just say, look, I can't afford this house that I have, right? And let's even not worry about future job loss yet, right? Okay, then you have other parties in the mix here too, which we've talked about. So you have the institutional sellers, right, who have been a big part of the buying on the way up here. They are not buying anymore, right? So they've really cooled off. So they're not at the buying table. I want to talk in a moment about, let's talk right now. So those are considered to be the smart money. And the fact that they aren't buying at these valuations probably supports that, right? But they're not all geniuses, right? And these companies can get into trouble, right? And so if they do, the risk with these guys is that they have no psychological or existential connection to the house. They don't need it for shelter, right? So if they get in trouble, this is just an Excel decision for them. Oh, we thought it was going to make this much money for us. It's looking like it's not now. Well, let's just let's sell it. And of course, selling it for them isn't just a unit. It can be many units,
20,
many
30.
times in the same area. So we're not necessarily seeing this happen yet, but the risk with these guys is that they could really start flooding metros with a lot of inventory right at the time where that's the worst thing that could happen for prices, correct?
Correct, and we are seeing it. Yes, that is correct. We're
You are
seeing
already
it.
seeing this. Where?
Yeah. So I just started a new series called The Forgotten American on my YouTube. And my second interview is with a citizen data sleuth down in San Antonio that I met, actually met him while I was on the road. He contacted me through X Twitter. But he has been able to dive into his market and find these big chunks of institutional selling. And you can look at the history, you can look at the fact that, so it's like First Key, American Homes for Rent. I'm going to talk about what some of them have done with the builders too in just a second. But he can go look up the ownership, look up these listings and see they got a big, huge tax bill because they don't get that homestead exemption that other people might get.
Mhm.
And they couldn't rent it out. You can see all the price changes of how they wanted to try and rent it out. And so they are now selling them. Now, what has happened as well in San Antonio is they'll partner sometimes with a builder and buy a big, or they did this before recently, buy a big chunk of these new homes and thinking they're going, either it was a built for rent or built to rent neighborhood, or it was just a big subdivision that's not selling. And so they'll buy those up at a discount. Of course, those don't show up in comps anywhere. And then when they get into trouble, they'll sell the whole thing. And so if you bought in that neighborhood, you are in dire straits because they don't have any emotional attachment, like you just said, Adam. and they're going to sell them at a deep discount. And so we're starting to see it. It's very difficult to find because you have to know how to look at these county records, and they're crazy. But it's also happening with like First Key down in Lee County in Florida. And so it's happening quietly, and it's hard to report on because of all the different entities they can use to sell and things like that.
Okay, but sounds like your expectation is that if and as that continues to happen, it's just pouring, gasoline on this fire already, this dumpster fire already.
Correct. That's
Okay,
right.
it's so hard to restrain myself when I talk to you, Melody, because there's so many of these topics we could just run with for an hour on each of them. But I'll keep moving on. So that's institutions. Then we have the short-term rental market, right? This is sort of the Airbnbs of the world. And spent a lot of time talking on this channel with you and a few others about this. Um, and those people largely, more than half the people who are in that space got in over the past 2.5 years. And it was, kind of during the pandemic, hey, easy way to make a lot of passive cash flow. And a lot of first-time landlords got in with dreams of riches in this space. I think for a lot of them now, it has metamorphed into a cash drain rather than a net cash positive venture for them. And again, a lot of these are pretty rookie investors, and so yeah, maybe some of them will say, "Well, let me try to convert it to a long-term rental scenario." That has its own challenges in this market, but again, this is another like ripe, several million units that are out there where people could just say, I'm not living in this thing and it's taking cash out of my pocket. Just sell it. Just let me get out, right? So that could be sending a lot more inventory into the picture as we go on from here, correct?
Absolutely. And it's happening in Florida and Texas already. You can tell that many of these, when you look at the listings, where short-term rentals are built to be a short-term rental.
Okay, so in addition to that, we also had, and I think this is probably more the higher end of the market, but maybe not. Um, Over the past decade, we had foreign buyers in a lot of markets, right? In a lot of markets, you wouldn't really even expect foreign buyers to be in, right? Around the country, but certainly out where I live in California, we had a lot of hot money from Asia. You've had hot money from Europe and Russia on the East Coast, but lots of other places too have foreign buyers you just wouldn't expect in America's heartland. But anyways, it seems like that money is cooling off a bit. And we were talking about this yesterday, and uh, I think you can look at that as, oh, okay, good. We don't have as much, competition coming from people outside the country who aren't going to be living in these houses anyways. Maybe that's a good thing. But you could look on the other side of that coin and say, well, people from outside the country are no longer buying in here. It's probably a sign that while our economy is slowing, theirs is probably doing a lot worse. And therefore, we may be having bigger macro issues with the global economy going forward, and that then sort of raises the specter of, gosh, do we go into a recession? Could that eventually be one of the things that leads to job losses that makes this whole situation a lot worse? Anything else to say about the foreign buyer side?
Well, I think it's funny, we're so concerned about, will Japan still buy our bonds? Will China, will Chinese still buy our houses? I mean, and the answer is no. And precisely because of what you're saying, Adam, even though when I first brought this up and I could tell, I was hearing anecdotes that Chinese were selling, for instance, people are like, the Chinese will never sell. They know this is, their nest egg forever. And it's like, when people get desperate enough, they will sell. And so I think it was a recent report just came out. I forget the reduction in year over year foreign buying, but it was significant, double digits for sure. And so I think what you're seeing, especially, you look at China, you look at the results from luxury with Gucci, LVMH, they are pulling way back. They'll pull back here. And so as everybody's looking at their Zestimate, you have to understand that that pool of buyers is just getting smaller and smaller and smaller. So who is going to buy your home?
Okay, that's exactly where I wanted to be taking this, right? We've just sort of been ticking off the lists of all the people that are based. If we think of the home buying market as like an auction room, right? We're just seeing more and more people get up with their paddles and leave, right? Okay, so then we get to my last point here, right? Which is homeowners, largely mostly boomers, with equity, right? And I'll lump kind of mom and pop landlords in here too, but because I think they have the same motivations, which is for a good deal of boomers, a large amount, in some cases all, of their retirement savings is in their house. It's in their home equity, right? And so they're married to their estimate, like you just said, right? And if prices start coming down, obviously they start losing their equity. And I've mentioned this a number of times in the past, but I think we're closer to this moment of whether I'm going to be proved right or not, which is there's a first mover advantage to bolt from the herd here, right? So I think, in general, homeowners are kind of sort of mass colluding right now. Hey, if we all just hang together, we
Right.
don't lower our prices, we don't sell, we wait for the Fed to lower interest rates, we'll make it through this together, right? Once cracks in that confidence start appearing, and if you're worried about losing your retirement because it's all in your home equity, you're going to say so there's some point at which you're going to break. You're going to say, you know what, I've lost 8%, 12%, whatever. I don't want to risk losing any more of my home equity. I'm willing to slink away, having lost only 12% of it versus holding on too long and then maybe losing 25, 30 or more percent, right?
Right.
So we do risk this. The more we go along with the trends that you talked about in the first half of this discussion, I think the odds of people starting to bolt increases. Then, of course, as soon as everybody sees that people are bolting, then it creates a cascade because nobody wants to be the last one left to turn the lights off and be sitting on massive losses.
That's right. And I think we've already started, I call that motivated selling versus distress. And I think
Mhm.
we've already saw that in places in Florida, in places in Texas, and really all over the country. The problem is you don't know it. You're not going to know it until it's too late because you don't know exactly who is transacting, selling, and buying. It's very difficult to get that demographic information. The MLS, all that information is kept very much under wraps. And so, I was laughing a couple months ago when everybody was talking about how hot Dallas was getting, for instance, again. I said, hold on, wait a minute. Your realtors are trying to create FOMO. Oh, no, it's the best neighborhoods. No, just wait. And Dallas right now is year over year price declines, not even 60 days later. And so, there's so much momentum out there and pushing this narrative that any little sign of rates going down or, it's the season. That's when you should be buying and selling homes. So there's a little more activity. Everybody wants to see it as the turnaround of the housing market, which is similar to how it was last time. But don't, be aware of these false flags is what I would say, because they're, I think the motivated selling has already started. You won't know it until it's too late.
Okay. And largely because we're not seeing it. We're actually, the data is not being shared with us.
That's
In
right.
some of our first interviews together, you did a deep dive on all the data that you think is basically being kept out of the MLS listings, right? Which is why you've gone, on your series of road trips where you're literally driving neighborhoods to try to get a sense of what the reality is on the ground. And in every case you've done that, it sounds like you're finding a lot more inventory and a lot more price weakness than what MLS has been
Correct.
sharing. Okay, so two last things. One is kind of been building up to this question, which is what precedes a dramatic shift in price direction is a change in sentiment, right? And it's people giving up this narrative that housing's bulletproof this time, and it's invulnerable, and it's going to buck the trend, and lag effects don't matter, and higher mortgage rates don't matter, and whatnot. And that has been the narrative right now, and that's why everyone is loving, hugging tightly to their estimate and looking at the June new median all-time high home price and saying, okay, phew, we're going to be okay, right? What could shift that, right? And obviously, more of the data that we talk about, at some point there'll be, some magic tipping point where people will start believing their own eyes versus what they're being told. But I want to tie this to just what happened nationally, right, with President Biden. I think if we could go back in time just a month, and talk to the Democratic leaders or people that are heavily involved in the Democratic Party, and we told them what had happened, they would have said, "You're totally lying. right? Like this, sort of a Titanic analogy. This ship is unsinkable. Like we're in a great position. And what has happened has been this massive sentiment shift. It's sort of an unmasking where people saw the debate and a few other data points and said, wow, this president, what we're being told about his level of fitness does not now doesn't seem like we can swallow it anymore, right? And I'm not making a personal comment about my assessment of his condition, but I just think that's what happened nationally. And enough people started questioning him, particularly his key supporters, both the media, the donors, et cetera, the ones that really mattered for him staying in office, that there was a shift, right? And now that we've just gone through this experience as a country, right, as a people, I think it's pretty natural for people to start saying, whoa, wait a minute. We were being told everything was fine. And all of a sudden, we've just realized overnight that it's not, right? With the guy running the country, what else isn't fine, right? So it lets this sort of, caustic doubt start to creep into the system. And so it's easier to start to worry and believe that the next thing you're worried about might actually be a problem, right? So you know, could we be kind of approaching this sort of cascading of sentiment that, of course, once it starts happening, it could all of a sudden maybe I think we're even maybe at the beginning parts of it where people are starting to say, wait a minute, they've been telling us the job market's fine forever too. But I know a lot of people have had real doubts of that because it doesn't match their own experience on the ground. And once people start realizing, oh my God, maybe unemployment's a lot worse than it is, then investors start making repricing decisions, then companies start making repricing decisions, people start pulling in their spending because now they're more worried than they were before. Do you have a concern, sort of like is growing with me, that given the shift we've just gone on at the national leadership level, that this could metastasize into other areas?
Yeah, I think you're tapping into something really important, Adam, and not something people are thinking a lot about. As Main Street, in my opinion, thinks very differently than Wall Street.
Mhm.
And I would be so interested to go. I forget when Biden did that CBS interview where he kind of got called out on the carpet about the economy, where the reporter was like, well, some people think it's not great. And Biden looked genuinely confused, like, what do you mean? And that was a moment, I think that might have been in May, it might have been actually April. And then you had Jay Powell, I believe in his last press conference, allude to the fact that he couldn't trust the employment data, right?
Mhm.
And so you have these two things happen right after one another. And I think as humans, we often don't even know why we do anything or why we don't do
Mhm.
it and what we're feeling and why we're feeling it. I mean, we're very terrible at that. But we have seen in the University of Michigan Consumer Sentiment Survey, I mean, I think it's the worst it's ever been. Where sentiment of, is this a good time to buy a house? It's the lowest readings, I think, in the series history. And so I do believe that sentiment started changing. Main Street started, and this is something I see every time I go out on the road, Adam. The conversation is so different from what you and I hear on FinTwit. I mean, just random people I meet can articulate what's going on out there way better than all these armchair warriors that we talk to all the time sometimes. And so I do think that you're hitting the nail on the head. I think that sentiment around the housing market, especially for lower and middle income folks, they don't care what the stock market is doing. They're looking at the political landscape, or they're feeling it, and they're looking at their own finances. And again, 39% of Americans are worried about paying their bills, and they're saying, no, absolutely not. So I think you have tapped into something I think really important that a lot of people aren't thinking or talking about.
All right. Yeah, you're making me think we should pull Peter Atwater back into this discussion because we need a
Yes,
behavioral economist's
yes,
input
yes.
here.
I'd love to hear what he had to say. Yeah.
All right. Well, maybe we'll call him together and then we'll do another one of these impromptu interviews.
Oh, that would
Um,
be fun.
all right. So last question. So for the folks who say, well, hey, look, we're just about at rate cuts. The Fed is just about to ride to the rescue here. What are the chances that you think the Fed can, quote unquote, save the day here with the rate cuts?
I mean, so fundamentally, I think most people misunderstand mortgage rates. We in mortgage, we focus on the 10-year. And the reason why mortgage rates were as low as they were previously is because the Fed was buying mortgage-backed securities at an escalated pace. Unless they do that again, you're not going to get the rates that are going to matter in the housing market. And I'm going to say what a lot of your guests have said, when they're cutting rates, it's not because good things are
Hmm.
happening. It's because bad things are happening. And we're definitely, I follow Macro Edge, they've got a great labor tracker. And the layoffs are just coming fast and furious. Rumors about Intel, doing 10 to 15,000 layoffs. I mean, so, I think that the picture is just going to deteriorate from here.
All right. And that's actually, I just want to make sure people take away your point there, which is unless the Fed goes back to really unnatural actions like super low interest rates, but also QE buying mortgage-backed securities, we're not the days of the tasty 3 to 4% mortgage are gone. So don't expect those to come back anytime soon. Maybe never. We don't know for
Maybe
sure.
never.
Okay. All right. Yeah, I've got some other pet points on lower interest rates, maybe actually even having the opposite effect than a lot of people that they're
Correct.
thinking are going to happen in the
Yeah.
market. But we'll leave it at there since we're coming up on the hour. Melody, it's always just such a joy talking to you, even though we talk about some scary stuff. You do such a great job of bringing the data and explaining it in a way that people can really understand it and hopefully take action on. So again, thank you for being willing to drop what you were doing to come on to do this unplanned with me. For folks that have really enjoyed this and would like to follow you in your work, where should they go?
Well, so I have a new venture I'm working on called Doomers News Network, and I would encourage everyone to check us out on YouTube. That is a weekly show of relevant news stories where we dive deep into the narratives and debunk them. As well, you can reach me at M3_Melody, Melody on X Twitter, M3 Melody Substack, and M3 Melody YouTube. But thank you so much, Adam, for having me on. I've really enjoyed it.
Oh gosh, it's always a pleasure. Melody, when I edit this, I will put up the links to those resources, both on the screen here, but folks, I'll have links in the description below this video as well. So you can get there with one link. Real quick, just before we wrap up, Melody, a couple things. One, folks, if you haven't yet, please show your appreciation for Melody by liking this video and then hitting the red subscribe button below, as well as that little bell icon. The day that this video should be coming out, we should have hopefully just crossed the 100,000 subscriber milestone on this YouTube channel. But if we haven't, we're like dozens away from it. So if you haven't subscribed yet, please do and help us make sure that we hit that milestone. And then lastly, if you are, I mean, what we're talking about, right, housing here, I mean, it's so meaningful because for so many people, it is the largest asset that they own, right? And for many people, it's the biggest percent of their net worth. We're talking about some pretty scary things happening to it. When you are, wrestling with fear, that's generally when you tend to make the worst decisions financially. So if you are, somewhat triggered by what we've talked about here, feeling vulnerable and feeling like you might need to make some pretty important decisions, highly recommend that you work with a, good professional financial advisor who understands all the issues that Melody and I have been talking about here, who can help you, walk through the logic of what you might want to do here. Should you be thinking about selling your home? If you have investment properties, what should you be doing with them? If you're waiting on the sidelines, what conditions should you be waiting for before you actually, start thinking about actually jumping into the market? Those are all decisions that a good financial advisor should be able to help you with. If you've got one who can assist with that, great. You should work with them. If you don't have one, consider talking to one of the financial advisors that Thoughtful Money endorses. These are the guys that you see on this channel with me here every week, week after week after week. So you should have a pretty good sense of how they think. To do that, just go to thoughtfulmoney.com, fill out the short form there. Only takes you a couple of seconds. These discussions you can have with them are totally free. There's no strings attached. There's no commitment expected. It's just a free public service that these guys offer. While you're at thoughtfulmoney.com, don't forget to click the newsletter link at the top of the website and subscribe to our free newsletter. And just a reminder, folks who do that and then upgrade to the premium newsletter get a whole bunch of benefits, but a big one of them is the macro pass service, where they get every week they get a premium bit of content, a premium report from one of the experts that comes on this channel week after week. We've got a whole panoply of them, so it's this great rotation. But I'm just flagging all this because this week's is going to be Melody. Melody was featured a little over a month ago. Folks really appreciated and loved what she had shared then. But this discussion was basically built off of two recent pieces that Melody just issued in the past 48 hours as of this recording. And so she's going to make those premium reports to her Substack audience available to Thoughtful Money's premium Substack subscribers as part of MacroPass. So Melody, thank you so much again for doing that.
Thank you.
All right. Well, that's it, Melody. I will definitely be extending the invite to have you back on again, kind of on the normal cadence here. But of course, we may be entering a period where the curveballs come fast and furious. And so if something happens that you didn't expect that kind of changes the calculus, please let me know and we'll have you back on, same day if you can.
Will do.
All right. Such a pleasure, Melody. Everybody else, thanks so much for watching.